All right, what's going on, guys? So today I want to talk about the difference between trading and investing, especially for those people who have just started investing stocks or they're just looking into getting into the stock market. They're two very different things, right? Investing is more long term. Investing is like you're buying a company because you believe it's going to be higher in the future on a long term basis. So, say you're buying Apple stock, right? Because you believe that 5, 10 years down the road, they're going to be making even more money than they are now, which is probably a decent bet. So you buy the company and you wait. And along the way, you collect dividends or whatever. So maybe you do this with Apple, or you do this with a good quality ETFs that track the whole market, maybe an S&P 500 index fund. Now, this is what I recommend for most people getting started. Long-term investing, right? So you got to think of your goals and your goals behind when you buy a certain stock versus, what's going to happen in the future. You have to have this planned out ahead of time, so that way when stuff goes wrong, you don't trade off of emotion or sell anything out of emotion and lose a bunch of your money. Trading is the opposite. Trading is more looking at the charts and the price volume and what the stock's been doing over a specific time frame. So like the 1 day chart for day traders, right? That's all they care about. The stock's moving up or it's moving down, whatever. They think they know what it's going to do next. They'll try to capitalize on that. Or you have swing traders. Swing trades can be very profitable depending on the time frame you're looking at. So, for example, we had the big sell-off last year in March because of COVID. And a lot of these quality companies, pretty much every single one of them, took a huge dip, right? So if you look at that 1 year chart, it's pretty easy to say, okay, this stock is down 50%. It's still a quality company. I'm making a bet that it's going to come back. And the majority of those stocks, pretty much any stock that you bought last year in March is up today. So that could be considered a swing trade, right? Because you're holding it for a period of time and then you're selling it when it hits your desired price target. The problem is when people go wrong and they lose a bunch of money in the stock market and they call it a scam because they don't know what they're doing. It kills me because I see it all over social media all the time. Have your goals in mind, right? So say that same person goes and buys Apple stock, right? And then they bought it in March or whatever. Maybe they didn't buy it in March. Maybe they bought it a month ago. And the market's moving along nicely. Everyone's making money. And then what happened the last couple of weeks, right? We had a huge sell-off, especially in the tech sector. So all these big tech companies took a hit. So then this guy who buys Apple, right? His shares are going down every single day. He's losing money. What does he do? He gets scared and he sells his position. And what happens right after that? Well, the market reverses and it starts going back up again. And then he gets mad and he calls the stock market a scam and whatever. Happens over and over and over. You have to understand your goals and why you're buying that stock in the first place. Like, why are you even buying Apple? If you believe in it long term, then why are you going to sell it 2 weeks later just because it's down 15%? It makes no sense. So if you're going to be in this investing for the long term, then you should be happy when the market comes down. I'm thrilled when it comes down because it means I get to buy more of the same quality product at a cheaper price. But people trade and people invest out of emotion instead of using common sense, and it bites them in the butt every single time. I mean, if you buy a house for 500 grand and 2 weeks later some guy offers you $400,000 for it, you don't sell it just because that's what the offer is for, right? You're buying it because you believe in it long term, and maybe you can rent it out the entire time or collect the dividend from the stock the entire time. Then you'll make money on the long term. But these people who just get started in the stock market and think, oh, I'm just going to be a day trader now. It's like, well, there's a lot that goes into that. Learning how to read price action and learning how to read charts and doing it over and over and over. And then you got to be able to know not only is it going up or down, but when it's going up or down. Like, that's super hard to do. I mean, the best of the best traders, that's really hard to do. If you want to make easy money in the stock market, go buy a quality company and then just wait. Maybe it pays a quality dividend, you just get paid to wait, but that's the way to do it. Trying to quit your job to become a day trader with all your 17 screens on your desk, it's not a reality for most people. But I want to spread this message that the stock market is very, very good, and it's helped me. It's probably the thing that changed my life the most, honestly, between that and real estate. So get into quality companies, get into solid ETFs, and hold them long term. And when the market comes down, instead of getting scared and selling your position, go in and buy some more. And I recommend, buying stock every time you get paid. So every time I get paid from whatever I'm doing, something that makes me money, I take a portion of that and I put it back into stocks to make more money, right? So that's the difference between trading and investing. So know what you're doing, know what your goals are before you get into the position. That way you don't get scared and sell your stock and lose a bunch of money.